After studying this module, we shall be able to focus on the interest tax shield advantage of the debt as well as its disadvantages in terms of cost of financial distress. Explain the impact of agency costs on the capital structure of the company. Discuss the pecking order theory of capital structure. Elaborate the approaches to establish a target capital structure. Study the various determinants affecting capital structure of the company.
In this module, we will discuss some other approaches of capital structure used in practice, the trade-off theory and pecking order theory. In the following sections, we will also discuss how the optimum capital structure of an enterprise should be and different approaches to establish target capital structure and other practical considerations in determining capital structure.
First of all, we will discuss the trade-off theory. We already know that the personal tax reduces the attractiveness of the debt. However, there are other disadvantages as well, which are grouped under financial distress and agency costs. Financial distress arises when a firm is not able to meet its obligations to debt holders. There are two types of costs involved with the financial distress: direct and indirect costs. Direct costs of the financial distress include bankruptcy costs, which includes legal and administrative costs, along with the sale of the assets at distressed prices to meet creditors' claims. Indirect costs relate to the other actions of the employees, managers, customers, suppliers, and shareholders.
Financial distress may ultimately force a company to insolvency. Direct costs of financial distress include bankruptcy costs. Specific bankruptcy costs include legal and administrative costs along with sale of assets at distressed prices to meet creditors' claims. The expected cost of bankruptcy raises the lender's required rate of return, which reduces the market value of equity. Financial distress also has many indirect costs. These costs relate to the actions of employees, managers, customers, suppliers, and shareholders. Employees of a financially distressed firm become demoralized because they are worried about their future. Due to this reason, their efficiency and productivity declines, which affects the quality of products, which in turn affects the reputation and prestige of the firm, and sales of its products may also drop. Customers. Customers of a financially distressed firm may fear its liquidation and get concerned about the quality of product or service provided by that firm. They are more concerned about after sales services and maintenance. As a result, the demand for firm's product or service starts falling. Suppliers. Suppliers also hesitate at the time of granting credit to firm, fearing liquidation of the firm. They force the firm into liquidation to realize their claims. Investors. The most important consideration for a financially distressed firm is its inability of raising funds for positive investments. Either the investors are not ready to supply capital to the firm, or they provide firm at high costs and rigid terms and conditions which in turn negatively affects the operating performance of the company. Shareholders. When a firm is under financial distress but not insolvent, the shareholders may be interested in undertaking risky projects by investing the left out cash. If a risky project succeeds, then gain can be substantial, but if it falls, creditors will suffer the loss because the shareholders have limited liability. Managers. When the firm is under financial distress, managers may have higher inducement to pocket firm's resources. Managers start taking decisions on the basis of short-term interest of the company. They may cut costs which affect the quality of products and sell productive assets to improve the short-term liquidity of the company. They don't consider any profitable opportunity to avoid any sort of risk. The decision will force the company to go into liquidation.
Financial distress reduces the value of the firm. Thus, the value of the levered firm is equal to the sum of the value of an unlevered firm and present value of the interest tax shield minus the present value of the financial distress. As we can see from the figure, the present value of the interest tax shield and present value of financial distress increases with the borrowing. With more and more debt, the cost of the financial distress increases and therefore the tax benefit shrinks. The optimum point is reached where the tax benefit and cost of the financial distress becomes equal and the value of the firm is maximum at this point. The next disadvantage of using debt is agency costs. In practice, there may exist a conflict of interest among shareholders, debt holders, and management. These conflicts give rise to agency problems, which involve agency costs. Conflict arises between shareholders and debt holders because of the possibility of the shareholders transferring the wealth of the debt holders in their favor. The conflict between the shareholders and the managers may arise on two issues: managers' tendency to consume some of the firm's resources in form of various perquisites, and managers' tendency to become unduly risk averse and shirk their responsibilities. The last issue is related to monitoring. Investors will discount the prices and pay less than they are willing to pay for the firm's securities, realizing that the managers may not operate in their best interests.
In practice, there may exist a conflict of interest amongst shareholders, debt holders, and management. These conflicts give rise to agency problems which involve agency costs. Shareholders and debt holders conflict. Shareholders' value is created either by increasing the value of the firm or by reducing the value of the debt. As we know that debt holders have a preferential and a fixed claim over the assets of the firm and shareholders have a residual and unlimited claim, debt holders' risk is very high in case of highly levered firms, since shareholders have limited liability. Debt holders are not even compensated for this high risk of default. The conflict between shareholders and debt holders arise because of the possibility of shareholders transfer the wealth of debt holders in their favor. The debt holders may provide money to invest in low risk projects while firms may invest in high risk projects, which in turn increases the risk of debt holders. shareholders and managers conflict. The conflict between shareholders and managers may arise on two issues. Number one, managers have a tendency to consume some of the firm's resources in the form of various perquisites. 2. Managers have a tendency to become unduly risk averse and shirk their responsibilities as they have no equity interest, and in order to protect their jobs, they may be passing up risky profitable opportunities. Monitoring and agency costs. Outside investors will discount the prices they are willing to pay for the firm's securities, realizing that managers may not operate in their best interest. Firms agree for monitoring and restrictive covenants to assure the suppliers of capital that they will not tolerate contrary to their interests. Agency costs are the costs of monitoring and control mechanisms. Agency costs of debt include the recognition of the possibility of wealth exploration by shareholders. Agency costs of equity include the incentive that the management has to expend the firm beyond the point at which shareholders' wealth is maximized.
We shall now discuss the pecking order theory. This theory is based on the assertion that investors have less information about the firm than managers. This is known as asymmetric information. The announcement of a share issue reduces the share price because investors believe that the managers are more likely to issue shares when shares are overpriced. Firms prefer internal finance since funds can be raised without sending adverse signals. If external finance is required, firms issue debt first and equity as a last resort. Managers will issue debt when they are positive about firms' future prospects, because a commitment to pay a fixed amount of interest and principal to the debt holders implies that the company expects steady cash flows. And managers will issue equity when they are not very sure about the future prospects. So, funds should be raised in the order of retained earnings, debt, and then external equity.
The pecking order theory is based on the assertion that investors have less information about the firm than managers do. This is known as asymmetric information. Other things remaining constant, because of asymmetric information, managers will issue debt when they are positive about firm's future prospects because a commitment to pay a fixed amount of interest and principal to debt holders implies that company expects steady cash flows, and managers will issue equity when they are not very sure about the future prospects because an equity issue would indicate that current share price is overvalued. Therefore, it is a signal to the investors about firm's future prospects. This implies that firms should always use internal finance, which is retained earnings, if available, and choose debt over an equity issue if external funds are required. Myers has called this theory as pecking order theory because there is no well-defined debt equity target and there are two kinds of equity, internal and external, one at the top of pecking order and the other at the bottom. Debt is cheaper than the costs of internal and external equity because of interest deductibility. Internal equity, which is retained earnings, is cheaper and easier to use than external equity because of no taxes on retained earnings and no transaction costs. Managers use retained earnings in preference to debt and equity because it avoids giving adverse signals about their companies. They will issue external equity when they think that shares are overvalued. The announcement of share issue reduces the share price because investors believe that managers are more likely to issue when shares are overpriced. The pecking order theory also predicts that if two firms are equally profitable, then the more rapidly growing firm will borrow more. The most profitable firm borrows less not because they have lower target debt ratio but because they don't need external finance. So, this theory explains negative relationship between profitability and debt ratio within an industry.
Let us now discuss the features of an appropriate capital structure. Capital structure may be evaluated from different perspectives. From shareholders' point of view, risk and returns matters a lot. Firm's capital structure should be beneficial for shareholders and generate maximum returns at minimum possible cost. Risk is the variability in return. Excessive use of the debt threatens the solvency of the company. From strategic viewpoint, flexibility and control concerns. The capital structure of the company should be flexible. That is, firm can easily change it if warranted by a changed situation. The capital structure should also involve minimum risk of loss of control of the company.
The features of an appropriate capital structure are: return. The capital structure of the company should be most beneficial for the shareholders. It should generate maximum return to the shareholder at minimum possible cost. Risk. Risk is variability in return which may be caused due to macroeconomic factors, industry factors, and firm specific factors. For example, excessive use of debt signifies the variability of shareholders' earnings and threatens the solvency of the company. Flexibility. The capital structure should depend on debt capacity of the company. The debt capacity depends on the firm's ability to generate future cash flows. Firms should have enough cash to pay fixed charges of interest and principal and leave some excess cash to meet future contingencies. The capital structure should be flexible, that is, firm can easily change it if warranted by a change situation. It should also be possible for the firm to provide funds whenever needed profitable projects. Control. The capital structure should involve minimum risk of loss of control of the company.
Now, we move on to the approaches to establish a target capital structure. There are three approaches to establish a target capital structure: EBIT EPS approach, valuation approach, and cash flow approach. The first approach is EBIT EPS analysis. If the probability of the rate of return falling below the cost of debt is low, the firm can employ high debt to increase EPS and vice versa. However, this approach does not consider the time value of money, ignores the risk component, and does not reflect the economic profits.
In EBIT EPS analysis, the firm should consider the plausible fluctuations in EBIT and impact of EBIT under financial plans on EPS. If the probability of the rate of return falling below the cost of debt is low, the firm can employ high debt to increase earnings per share. This may also have a positive effect on firm's market value. On the other hand, if the same profitability is high the firm should refrain from employing too much of debt. Thus, the greater the level of earnings before interest and tax, that is EBIT, and lower the possibility of downward fluctuations, the more beneficial it is to employ debt. However, EBIT EPS analysis also suffers from certain limitations. In choosing between debt and equity, sometimes too much attention is paid on EPS. The major shortcomings are: EPS is based on arbitrary accounting assumptions and does not reflect the economic profits. EPS does not consider the time value of money. EPS ignores the risk component. The belief that the investors would be just concerned with the expected EPS is not well founded. Investors, in valuing the shares of the company, consider both expected value and risk.
The second approach is valuation approach. As we know that debt causes financial risk, which increases the cost of equity. Higher debt increases the cost of financial distress and agency costs. The interest tax shield component adds value to the shareholders. Thus, there is a trade-off between the tax benefit and the cost of financial distress and agency problems. The firm should use the debt up to the point where the marginal benefits and the cost are equal.
As we know that shareholders assume a high degree of risk than debt investors, hence, debt is a cheaper source of finance than equity is. But debt causes financial risk, which increases the cost of equity. Higher debt increases the costs of financial distress and agency costs. The interest tax shield component adds value to shareholders. Thus, there is a trade-off between the tax benefits and costs of financial distress and agency problems. The firm should use debt up to the point where the marginal benefits and costs are equal. This will be the point at which the firm's value is maximum and WACC is minimum. The difficulty with this approach is that managers find it difficult to apply it in practice. It is not possible for the firm to quantify the effect of debt on firm's value.
The third and the last approach is cash flow approach. In determining a firm's target capital structure, a key issue is firm's ability to service its debt. The focus of this analysis is also on the risk of the cash insolvency, the probability of running out of the cash given a particular amount of debt in a capital structure.
Cash flow approach focuses on the main areas, which are cash adequacy and solvency, components of cash flow analysis, reserve financial capacity, cash adequacy and solvency. In determining a firm's target capital structure, a key issue is the firm's ability to service its debt. The focus of this analysis is also on the risk of cash insolvency, the probability of running out of cash given a particular amount of debt in the capital structure. This analysis is based on a thorough cash flow analysis and not on rules of thumb based on various coverage ratios. Components of cash flow analysis. The expected cash flows can be categorized into three groups. Operating cash flows. It relates to the operations of the firm and can be determined from the projected profit and loss statements. Over the period of times, sale volume, sale price and input price should be carefully examined. Non-operating cash flows. It is the cash flow that company gives or receives from sources other than its operations. It includes capital expenditures and working capital changes. During recession, the firms may have to specially spend on advertising for the promotion of its product. Certain expenditures cannot be avoided even during most adverse conditions. They are necessary to maintain the minimum operating efficiency of the firm's resources. Financial flows. It includes interest, dividends, repayment of borrowed capital. It includes two types of obligations, namely contractual obligations and policy obligations. Former is the matter of contract and should not be defaulted, like interest and lease rent, and latter is at the discretion of the board of directors, such as dividends. Reserve financial capacity. Reduction in operating and financial flexibility is costly to firms competing in charging product and factor markets. Thus, firms need to maintain reserve financial resources in the form of unused debt capacity, large quantities of liquid assets, excess lines of credit, and access to a broad range of fund sources. The focus of cash flow analysis is on liquidity and solvency. It identifies discretionary cash flows. It lists reserve financial flows. It goes beyond financial statement analysis and it relates debt policy to the firm value.
Cash flow analysis has some advantages over EBIT EPS analysis. It focuses on the liquidity and solvency of the firm over a long period of time. Thus, it evaluates the firm's ability to meet fixed obligations. It goes beyond the analysis of profit and loss statement and also considers changes in the balance sheet items. It identifies discretionary cash flows. The firm can thus prepare an action plan to face adverse situations. It provides a list of potential financial flows which can be utilized under emergency. It is a long-term dynamic analysis and does not remain confined to a single period analysis. In addition to EBIT EPS analysis, valuation and cash flow analysis, there are some other practical considerations also which the firm needs to consider while deciding about its capital structure. Forms of assets play an important role in the capital structure. Tangible fixed assets serves as the collateral securities for debt. Companies with the higher intangible assets have higher cost of financial distress. The next point is related to the growth opportunities. Growth firms would prefer to take less debt with lower maturity period to keep interest rates down. Firms with limited growth opportunities face the risk of the manager spending free cash flow either in unprofitable businesses or in risky businesses. This behavior of managers can be controlled by high leverage. After this, we have debt and non-debt tax shields. Firms with larger non-debt tax shields would employ low debt as they may not have sufficient profit available to them. Then we have the financial flexibility, which means a company's ability to adapt its capital structure to needs of the changing conditions. The company should be able to raise funds whenever needed. It should also redeem its debts whenever warranted by the future conditions. So, capital structure should be flexible enough. Next consideration is loan covenants. Covenants in loan put some restrictions like restrictions on cash dividend, capital expenditure, etc. Private debt contains both positive and negative covenants, while public debt has lot of negative covenants. Growth firms prefer to take private debt rather than public debt as it is much easier to negotiate terms with few private lenders than several debenture holders. Financial Flags says that the company should not borrow to the limit of its debt capacity and keep available some unused capacity to raise funds in future. If a company has the option to repay its debt before maturity, a considerable degree of financial flexibility will be introduced. Issue costs also matters a lot in the capital structure. Generally, cost of debt is less than the cost of equity, which encourages the companies to use debt more than the equity. At last, we have capacity of raising funds. A small company finds great difficulties in raising long-term loans. If it is able to raise, then rate of interest will be too high and inconvenient terms. Therefore, small companies depend on share capital and retained earnings. In this module, we have learned about the trade-off theory and the pecking order theory. We have also studied features of an appropriate capital structure, approaches to establish a target capital structure, and practical considerations in determining capital structure.
Let us now recapitulate what we have learned in this module. There is one more factor which reduces the tax advantage of debt. It is financial distress, which is costly. It includes cost of inflexibility, inconvenience, and insolvency. Thus, the value of a levered firm is VL is equal to VU plus present value of interest minus present value of financial distress. The value will reach optimum value where advantage of issuing debts interests equals present value of costs of financial distress. The firm's capital structure is also affected by agency costs. Agency costs arise because of the conflict between managers and shareholders' interests on one hand and shareholders and debtor holders' interests on the other hand. The trade-off theory predicts that safe firms should borrow more than the risky ones. The advantage of debt is that it saves taxes because interest is tax deductible. Its disadvantage is that it can cause financial distress. Therefore, capital structure should be governed by the trade-off between tax advantage and costs of financial distress and agency costs. Many firms in practice follow a pecking order. They first use retained earnings, followed by debt and then equity. There are three approaches to establish a target capital structure: EBIT EPS analysis, valuation approach, and cash flow analysis. Apart from the above approaches, there are other practical considerations also which must be kept in mind to determine the capital structure of the company, like forms of assets, growth opportunities, loan covenants, issue costs, etc.